shady bank businesses. You see what I did there? Shady bank business. You sit in the shade today because somebody planted a tree a long time ago. This is the old adage about investing. But nobody ever completed this adage and asked, what if the tree is cut down? Hello, my dear YouTube investing fans. My name is Ali, your friendly neighborhood value investor. Today, I look at the recent collapse of banks happening in the USA and abroad and give my 2 cents on the matter of shady bank businesses. You see what I did there? Shady bank business. Never mind. What would happen if you lost 100% of your investment? This is a serious problem, isn't it? Usually as investors, we would put it in the worst case scenario bin, then throw the bin in the corner and never worry about it. But sometimes that bin can spontaneously catch fire and our worst nightmare comes true. That's why something called asset allocation is important. But before that, here is a quick summary of what's happening in the market.
Number 1. Silicon Valley Bank or SVB.
SVB Bank bought too many long-term Federal Treasury bonds. They were bought when the interest rates were low, but now since the interest rates are high, they had to sell assets to keep the float in the bank stable. However, in trying to assure customers that SVB Bank is being proactive, it caused a bank run. A bank run occurred and now SVB Bank is nothing. If you had deposited money in the bank, then at least you get that back. But if you had invested in SVB, you had bought shares, those shares are now worthless and you are sitting in the sun. In the sun. A lot more details can be found on Silicon Valley Bank and its collapse. But mind you, it's mostly about bonds, valuating bonds, and some things about VC funding drying up. As the Financial Times put it, gormlessly, SVB had amassed a stupendous pile of uninsured deposits, almost entirely in just one industry, that was burning through its deposits as VC funding dried up. Gormlessly is my new favorite word.
Number 2. Following the collapse of SVB, depositors withdrew billions from Signature Bank, which led regulators to shut it down on March 12. On its last day of public trading before the closure, Signature's stock also plummeted. The bank's failure resulted in it becoming the 3rd largest bank failure in US history.
So, Silicon Valley Bank collapsed, Signature Bank collapsed. But wait, there's more. Now, number 3. Now news about Credit Suisse is swirling around. Credit Suisse, the giant Swiss bank for the rich, has been in hot soup for some time already. Auditors picked up some vagaries in its reporting about material weaknesses. Basically, the bank is not as healthy as they are claiming. But its situation was made worse when Saudi National Bank mentioned that it will not bail out Credit Suisse if it failed. Now this is big news because Saudi National Bank is Credit Suisse's biggest shareholder. Year to date, Credit Suisse has tumbled 36%. But looking at 52 weeks data, which is 1 year, Credit Suisse has tumbled 74%. Yikes! This is a close example of somebody not just chopping down the tree, but slowly burning the tree down. For now, however, the bank has a saving grace, UBS. UBS will pay for 3 billion Swiss francs, which is 4.34 Singapore billion dollars, and it will assume up to US $5.4 billion in losses in a deal expected to close by the end of 2023. They call it a merger, but it's like a bailout. However, in this merger, there are some casualties. Bondholders of the additional Tier 1 bonds will lose all their monies as the bonds are written down, and shareholders will take a hit as well. 22.48 shares of Credit Suisse will earn you 1 share of UBS. You could say Credit Suisse got served some cheese. Long story short, the purpose of me sharing about these banks is that there is no 100% safe investment. Banks were supposed to be the institutions that do not fail because they are able to take money and magically loan out more than they have. thus earning interest. That is a never-ending flow of income. But that's now basically false. Just in 2008, we had the spectacular collapse of Lehman Brothers. The repercussions were international. Barely 15 years later, we are seeing history repeat itself. But if investments are never 100% safe, how should we as layman investors proceed in allocating our funds? Today, I want to focus on something called asset allocation. Asset allocation is the process of deciding how to split up your money into investing in different financial instruments. The three common ones being stocks, bonds, and cash. But it is also a bit more than that. It's also about diversification to minimize risk. These are some super important terms: diversification and risk. Diversification is simply saying, don't put all your eggs into one basket. Risk is about asking, how much money can you lose in that specific investment you are making? Let's start with risk. In the financial world, there are many types of risks: systemic risk, credit risk, interest rate risk, and many others. All they are trying to calculate is how safe or unsafe an investment is. Another way of thinking about risk is, how much are you willing to lose? Then we go into diversification. Now, if you were to own $100, would you invest it all in buying the stocks of only one company, like for example, Singapore Post Limited, ticker symbol S08, the company that runs SingPost or Singapore's national postage provider? In 2018, the stock price was $1.30. In 2023, the stock price has dropped to 50 cents. If you invested $100, it would now only be $49. But instead, if you had divided the $100 into 4 companies, Singapore Post Limited, DBS Bank, Wilmar International Limited, and Capital Land Investments, then 3 out of 4 would have given you positive returns, and only 1 would be in the red. You already know which one. So that's the general idea behind diversification. The strategy is not just hearsay, but has been mathematically proven over and over again. It's employed by regular retail investors and professional money makers alike. Intuitively, it just makes sense, doesn't it? However, there is one man who disagrees with the way risk and diversification is portrayed by the professionals, and this man has $140 billion to prove it. His name is Warren Buffett. And Warren's take on risk and diversification is that it's only useful when you don't know what you are doing. However, if you are prudent in your choices, thorough in your investigations and research, methodical in your approach, and emotionless about money, then you should be putting all of your eggs in only one basket. But you have to make sure that that basket is stupendously built, like made of titanium, stored in a vault or something, so that, nothing can happen to that basket, and thus your eggs are safe. Or, as he likes to say it, only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. Personally, I'm a huge believer in everything Warren Buffett, but I'm not yet at the level of being able to dissect the business like he is. So I don't mind sticking to diversifying my money somewhat. As it comes to risk, my philosophy is simple. If I don't understand the business, I don't invest in it. That's why I have never bought, probably will never buy, any bank stocks. I hope you liked this video. Please remember to hit that like button and subscribe. Share this video with your friends and family, and please do comment and tell me if you have any bank stocks and are you feeling safe. Bye everybody, take care.